Hey, how you guys doing? My name is Abdurrahman Ali. I am in Zaying Merger's class, and I will be talking to you guys about Lab 6 or Assignment 6, which is Section 3 Stock Evaluation. I'm sorry about my voice. I'm a little bit sick. My voice is gone, but I can still probably get through this without any problems, all right? So let's get started. Let me take this out. Let me pop this out. This will be my work page. This will be what I will be explaining. Another way of explaining. Give me 1 second. All right. So let's get started. What we'll be talking about is Section 6 Assignment Stock Valuation Analysis. Let's first, what does stock valuation mean? So, you can understand. Stock valuation means the process of determining the instincts or theoretical value of a company's stock to determine whether it's undervalued or overvalued. Basically, is it worth it or is it not worth it? That's basically what we'll be doing. So they give us an imaginary scenario we're supposed to figure out. So in an imaginary scenario, you just inherited $75,000 from your great aunt who always said invest in quality companies. You're considering Microsoft stock currently trading at $380 per share. So $380 per share, you have $75,000. Microsoft pays an individual dividend of $3 per share annually. So every year you get $3 per share if you own one share. Dividends have grown at 10% annually for the past 5 years. Analysts expect 4% growth going forward. So they're not expecting 10% anymore, they're expecting 4%. The S&P 500 has returned 10% annually on average. Treasury bonds currently yield 4.5%. You could alternatively put the money in your savings account at 4% annual interest. So basically the big answer is what should I do and which one should I choose? And is there a better option, and is Microsoft stock worth putting it in? What is Microsoft worth using the dividend discount model? How sensitive is its value to growth assumption? If you buy at $300, what return can you expect? Is the $300.80 a good buying price? Should you invest in the full $75,000? So let me kind of explain it to you guys a little bit easier. So this is the graph of how it works. If this would be good. All right. Let me show you guys. Let me go back up. So basically, you are getting $3. You'd be getting around $52 to $65 per share, which is not much. Your current dividend is $3, and at $3, your next after in 1 year your dividend will only be $3.12, which is not much per share. And after 6 years, it'll be $3.12. So it's not really going up much. So let me explain to you what $3 means. So if you have $75,000 divided by 3, you would get $25,000. I'm sorry. If you were to have 75,000 divided by $380, which is how much stock is, you would have 197.79. 100. Let's round it up to 198 times whatever the stock would be times 3. You're only making $600 from a $75,000 investment. So you gotta think about it. Yes, it's good to have $600 for free every year, especially if you're not doing anything with the money. But considering the fact that you're investing $75,000, is it a good investment? I don't think so. I really don't think so. You're making less than 2% back. I don't really think it's a good investment. I would not recommend you to do it. Let me explain to you guys a little bit more so you guys can understand. So, the simple answer is that Microsoft is likely overvalued. So after finding that, we realized that, okay, if you're making only 3.5, that's not really worth it. What's good is, S&P is giving you a 10% return rate on whatever value there are. So a 10% return rate is way better than whatever that is. $3. If you're currently looking at $3, 300. If you were to make 75,000, You divided by 600. Wait, no, sorry. Flip it. 600 divided by 75,000. You are making 0.08% return. That is absolutely nothing. You're not really making anything, you know. So I would not really recommend that. Um, uh, I would really recommend something else. S&P is really good, but let me explain to you guys now how this thing works. First thing is record the problem as infected by the second term. You are accepting a future return that is barely better than a risk-free treasury bond. So you're not really making that. It's too high. $380 is too much. The required rate of return is the minimum you need to justify the risk of buying an English stock since you don't have the intrinsic value of Microsoft use the golden constant growth. Expected return. If you buy a $30, you can see return Microsoft is actually offering you. It's only offering you 0.082%, which is around, give or take, not much. See what I was exactly what I was telling you guys. You're averaging a return rate of 0.082% plus 4% every year is not much because it's very low anyways. So I would not recommend that. This is really good. S&P 500 market average 10% return rate annually on a high market. You're getting way better, way lower risk, and way better than that. You are taking conclusion because you are taking on the high risk of owning an individual stock, but the expected return is only marginally better than a risk-free treasury bond, 4.5%. So you're taking a risk. It'll be better for you to just put it on annual savings account when you're making 4%. It'll be way better for you to just put it in there. You'll be making more and more money back. Or instead of putting it in Microsoft for only a little bit more. Is $380 a good buying price? No. The low expected return of 4.2% does not justify the risk of buying an individual stock. Individual stocks can go up, can go down. I want to recommend it. Look somewhere else. Do not invest in any into Microsoft. If your goal is to achieve an appropriate return for the risk, since you're a great onset to invest in quality companies, you should look for quality that is not so expensive. Recommendation: consider putting the $75,000 into a low-cost S&P 500 index fund to target a 10% market return, or look for other quality companies that offer an expected return closer to 10% target, which is what we're looking for. Better option they give us here: the S&P 500, which is around 10% diversified stock, where they invest in 500 largest U.S. companies and you get a way better return outcome of any of these. You own 499 other companies that are great, including Microsoft, and imagine your target, and there's an average return. So it's more, you're making more money and you're making a more secured thing. So Microsoft conclusion is too much risk or too little return. S&P index is ideal match for 10% great growth, and treasury bonds are good for capital preservation, but too low return for growth. So if you're looking to just maintain your money, it's perfect. If you're looking to increase your money, I would definitely recommend the S&P 500 index fund. Other than that, there's not really much more to talk about. We answered all the questions. What is Microsoft using the dividend? What is Microsoft worth using the dividend? It's not really worth much. You're only making a 0.082% return and 4.82% after everything, after the increase. How sensitive is this valuation to growth assumptions? Very. If you buy at $300, what can you return to expect? I already told you. If you're buying at $308, all of the money you should be expecting around $594 back. Give or take, some up a little, maybe a little bit less. Is the $300 a good buying price? No, it is extremely high, and you're not getting enough. Should you invest? I would not recommend investing $75,000. All I'd recommend investing in the S&P 500 index because you'll be diversifying your money, and even if one stock goes down, your money doesn't go down because only one out of 500 went down. It's very secure and it really goes, and it's very strong. I would recommend looking somewhere else, which is S&P 500. It's a really good option. Besides that, I think we answered everything that we need to answer. Let me know if you guys have any questions about anything, and I think that'll be it.